Good afternoon. This is Tom Alexander. I'm going to do a special midweek update because the NDX, SPX, and Dow have closed as of today, Wednesday, in new all-time highs. Again, this is Wednesday, May 15th. It's about 6:20 p.m. Eastern Time in beautiful Charleston, South Carolina. And today is a very, very important day, so I wanted to do this update. And I'm going to do something very radical here. It's something that you probably don't see very often in the usual places in the media, in the social media, on Twitter and things like that. What we're going to do tonight, we're going to take the wild step and we're going to deal in facts. We're not going to deal in guessing. We're going to deal in facts. And it's the reality of being a trader is that if you're a profitable trader, then you deal in facts, and if you're not profitable, then you deal in magic and supposition and all these other things that you see on Twitter and some of these other places. So let's just take a look at the charts and sit back, take a breath, and look at some facts and see what the facts alone can tell us about this market and see what conclusions we might be able to draw from just looking at the charts. So let's take a look at the charts. Okay, we're going to go through each of the four primary indices. We're going to start with the SPX. So we have closed a new all-time high ground. There is nothing above the current market that is quote unquote resistance. From an auction market perspective, the only thing that can be resistance is some former trade, something on the horizontal scale of the chart, something that has previously occurred between the buyer and seller that is some indication of value or lack of value. Well, we closed, there's just simply nothing above us. Now, to the downside, what is support to the downside? And support, I don't like the term support and resistance. They are in, they're inflection points. But what has happened is important because what has happened is something that has occurred between buyers and sellers. So the immediate level to the downside now is today's session low. And then below that is this little pivot that formed in this 3-day balance area that formed Friday, Monday, and Tuesday of this week. This is Wednesday's trade here. So it's really simple. It is a fact that we're at new all-time highs. It is also a fact that there is no quote unquote resistance above us. There is nothing preventing this market. There's no area of quote unquote unfair value. There's no high volume node above us. There's no low volume area above us. It's pure virgin territory as high as this market chooses to go. The initial signal that something could be forming to the downside is if we close below today's session low. And for reasons that I'll get into as we get deeper into this, any top that's formed in here, I think is a temporary top. And the reason I believe that, part of the reasons, is that we have all three of the largest indices, the most followed indices, the SPX, the NDX, and the Dow, all made new highs simultaneously today. The Russell is also strong. It's lagging, but it's and we'll get to it in just a minute. But before there's a top of significance, I think you're going to see divergences among and between these three indices, the SPX, the NDX, and the Dow. That's typically what happens. Now, I can throw the Russell into the mix, but we've seen a divergence in the Russell that has been ongoing now for well over a year. That may be a tell in the long term, but the market can go a whole lot higher, and the Russell never exceeds its all-time high. It's a different animal at this point. It's a different part of the economy, and this is a market that continues to be driven by momentum and a relative handful of stocks, actually. Okay, let's take a look at the NDX. NDX, new all-time high ground. The Dow, new all-time high ground, and the same concepts apply. I have highlighted the downside levels that are important. These are posted on the website. If you go to the website, alexandertrading.com, look under weekend reports, you will see this is a special weekly report. There's no charge. You can click on it. You can see the weekend reports that I have posted before and see what I was saying prior to this, if you choose, if you'd like to do that. What else? There's something else I wanted to show. Well, let me just show you the Russell real quickly here. Here's the Russell. So this is the April high in the Russell. Now the Russell hasn't taken it out, which is sort of interesting, but the all-time high in the Russell is way back here 3 years ago, 2.5 years ago. So if we were to get there, it would be an epic bull run, no doubt. Now, getting back to the reality, and how do you trade this? Do I just sit on my hands unless it takes this out? Well, that depends on how you trade. It depends on the time frame you trade. The market is certainly getting stretched to the upside. It is not going to continue up at the same rate of change that we've seen over the past 2 weeks. In the last 2 weeks, the market is up 6%. Now, that may sound like a lot, and it's a lot for 2 weeks, and certainly the rate of change is going to slow down. But if we go back and we look off of the bottom that formed in November, now it's true, this was coming off of a pretty substantial correction percentage-wise from this high to this low. We were down 10, 11%, but you know, we had the SPX rallied almost 17% before we had a 2% drawdown. So to put things in perspective. Now, are we going to see this again? I don't know. But let me share this with you as well. If you notice, we kept making higher lows all the way up. And if you had honored that and if you're a swing trader or position trader and you honored that, you kept yourself out of trouble and you kept yourself on the right side of the market. Now, let's say that, well, gee, Tom, you know, I trade intraday, I swing trade, etc. I'm going to say I do too. And what I use, you can go down to a 30-minute chart. The exact same concepts apply. Here are the immediate levels. This is today's cash session low. This is the higher low, the higher low. This is an elevator shaft all the way down to here. Now, again, this is a 30-minute chart. You can go down to a 5-minute chart. And the same concept applies. And, you know, you can get as granular as you want to get with it. I do not go below a 5-minute chart. But until these lows begin to be taken out, right now you have no lean to short this market. If you short this market here, then your lean is going to be whatever high is made prior to that. Now, if the market goes up and it forms another pivot, a higher low, et cetera, that's what you do. You know, trading doesn't have to be complicated, and trading is made far more complicated by using magic numbers and oscillators and all this stuff that most people use. Of course, we know most people lose money trading, and that's part of the reason why. The simple things work. The market is reality. This is reality, and until these higher lows in the time frame you trade are taken out, the trend is up. So you're either flat, long, looking to get long. You don't fight a market that is going directionally without any sort of indication whatsoever that there is a turn, and that will keep you out of trouble. Okay, let's look at a couple of other things here. Let's look at breadth and the internals. Now, well, this is VIX. We landed on VIX, so let's talk about VIX for just a minute. So you can see VIX is approaching a yearly low. That is not necessarily bearish. VIX can stay low for a long period of time, and the market can rally a long way with VIX, especially with VIX making lower lows. But VIX can sort of flatline and expand and contract in a narrow range while the market rises. So VIX is supportive of the idea that a top could be considerably out into the future. Now, if we look at breadth, let me find my breadth chart real quickly, if that's possible. Okay, here we go. Now, what you see here, this is basically just NYSE data. The red line is 10-day moving average of NYSE advancing issues. The red line, the green line is a 5-day moving average of advancing issues, and the blue histogram is closing NYSE breadth. Now, we have the last time the 10-day moving average of NYSE advancing issues was at the level that was at today was back here. This was back in July of 2023. Typically, this is positive. The market can go higher for a long time, and this can actually decline as it goes higher. A perfect case in point was this area right in here when we had this huge spike in the 10-day moving average of breadth. We had a little bit of a decline. Market went straight up. Now, you can have peaks coincident with breadth or near coincidence with breadth. That can occur. But again, how do you know the difference? Well, always default to price. Some of this stuff is, well, almost all of it is correlation, not causation. You have to have price confirmed. Price has to validate any narrative, any technical narrative, any fundamental narrative. So unless the market begins making lower lows and lower highs, you're working under the assumption the market is going higher. However, okay, and I will say this, and I admit this, short term, the market is getting extended. Now, that doesn't mean something like this is imminent, that we're going to go straight down. What it implies, and what is far more likely, is that we see something like this. Let me go back over to this chart. That we see a market that begins to do, I'm going to take off some of these lines because it gets busy. I like nice, clean charts. So we had this strong advance that began in January up, but you can see it became much more two-sided from here into this top than from the November low into the January high. And you had very regular retracements of something around 1.5 to 2+% on a regular basis in a more rotational market. Well, we've had anything but a rotational market since the low back on, when was this? The 2nd of May. It's been straight up. So what I would look for sooner rather than later, likely by the end of this week, is a market that has more overlap in price. So maybe we go higher again tomorrow. Who knows? Nobody knows. But then what you will see, you'll begin to see a deeper overlap into a previous day's range. And then you'll have occasional days where you have an inside day. And even if the market's going a whole lot higher, you'll have a more rotational day-to-day market. This is the concept of trading market condition. Now, am I predicting this is going to happen? Yeah, I guess I am. Because that's the one thing in an auction market you can predict. You can predict that the market is regressive around value. However, value migrates. But there is going to be a more rotational market kick in at some point in time, even if it's a directional rotational market, as was the market from the first week in January into this April top. So that's where I think we are. I think we will begin sometime almost immediately to see a slowing of this uptrend and a more rotational market intraday and on a day-to-day basis. Could we just top here and go straight down? we all know anything's possible. But what has to happen first is you've got to have a 5-minute pivot taken out to the downside. So if that is if you're just totally convinced that the market's about to drop 25% by Friday, let it take out a 5-minute pivot first and save yourself a lot of anxiety and at least have a reasonable stop. Okay, guys, hope you found this helpful. Please subscribe, please like, check out the website, alexandertrading.com. Go to weekend reports. That's where this will be posted, the charts and other stuff as well. I'll speak with you again soon. Have a good evening.